Good afternoon. Thank you, everyone, for joining us today. We are very excited to see so many of our clients, consultants, and prospects on the line. Welcome, everyone, to our first US CIO Outlook webcast. We hope to make this an annual event going forward. I am Valerie Arnold, co-head of North American Distribution at Pzena Investment Management. Here at Pzena, we are solely focused on one thing, value investing. With a global research team of 27% professionals, we use fundamental research to build our portfolios from the bottom up, company by company. What differentiates us from other investment managers is our relentless commitment to value investing under all market conditions. We have a unique team-oriented culture that allows us to stay invested in the cheapest part of the market throughout an investment cycle, which we believe provides the best long-term alpha for our clients. While value investing has underperformed over the last decade, we have persevered. I am pleased to announce that we finished 2019 with a new peak in AUM of $41.2 billion. We had approximately $1.4 billion in positive net flows in the fourth quarter, and we have had positive net flows for the previous 4 years. No doubt, an enviable record for high active share, deep value manager. We believe this growth is happening as investors are concluding that extraordinary valuation spreads are available in the market today, makes now the time to add to a true deep value strategy. I am here with our founder, CEO, and co-CIO, Rich Pzena. Rich founded our firm nearly 25 years ago, and he is also a portfolio manager on our US Best Ideas, US Mid-Cap, and Large Cap strategies. For today's call, I will be asking Rich some questions that we often hear in the market, but please do send us your questions as well. If you have any questions throughout the call, please type them into the question box so we can answer them at the end of my prepared questions. Rich, thank you for joining me today. Before we get into your 2020 outlook, can you talk about how we got to this point and review what happened during 2019?
Sure, and thanks, Valerie, and thanks everybody for listening. 2019 was kind of a transitional year that followed a period of pretty tough results for traditional value investors. And the fourth quarter was one of the best quarters we have ever had. So how do you explain something like that? I think the reality is that the macroeconomic environment was transitioning from a period of weakening, recession maybe is too strong of a word, but quasi-recession, where industrial production was declining, and all of this uncertainty was due to the things that we're all so familiar with in the news now: trade wars, potential Middle Eastern military conflict, leadership issues in countries, and that's led to this sort of period of economic uncertainty, but it was actual economic weakness. And that weakness started bottoming out as we got towards the end of the summer. And so the bottoming out was met with a massive correction for cyclical stocks and for stocks in the traditional value camps. And while it may be controversial for me to say that the uncertainty is gone because we have a day like today in the stock market, there's still things in the world that create uncertainty. But if we were sitting here at the end of 2018 or the beginning of 2019, and you surveyed economists about what their outlook was for the next 12 months, you had a reasonable number, maybe close to half, thinking that we could be in a recession in the next 12 months. And today, when you survey economists, you can find almost none that think we're in a recession in the next 12 months. And I think the primary reason for that is because we had the recession. Now, I understand that we didn't have a technical recession, but this is the second time in the last 10 years where the economy has worked off its excesses. The global economy has worked off its excesses. And so we saw this post the emerging market meltdown, where we transitioned from this go-go growth environment of thinking that that China was going to perpetually lead the world in demand for industrial goods and commodities, and the world would be perpetually short of those commodities and goods, and then the demand weakened. But the demand didn't weaken until the suppliers of these goods and commodities went nuts trying to expand their capacity. And that capacity expansion overdid it. That leads to recession. That's the definition of a recession. When you recess from excess, the excess happened to be in capital spending and the industrial and commodity and basic material sectors. And when that reversed, it reversed big time. And that led to kind of this downturn, whatever you want to call it. You can't call it recession because it doesn't meet the technical definition of a recession, but downturn. And then when that downturn ended, value rallied again. Then we had another set of uncertainties that started a year ago or a little over a year ago. That sort of ended, and we had the pop. So we enter 2020, I think, in a bit of a different place than we entered 2019.
Rich, what do you think caused the turn in the fourth quarter? Was there any sort of catalyst to point to?
I really think it when you work off the excesses, it means things come down, and eventually the excesses are gone, and then they stop going down. So that's it. Industrial production went from negative to zero. I mean, we saw things that were kind of remarkable. You look at the interest rate environment. We were in a period of declining interest rates from mid-18 to mid-19, and the 10-year Treasury went down to 1.5 or something like that, and then it popped up to back to close to 2 or almost close to 2. You could look at it in some of the negative interest rates in Europe, like the German 10-year Bund went from negative 70 basis points to negative 20 basis points, which I know doesn't sound like a startling reversal of fortune, but it was sort of the end of the economic malaise. And you know, you package that with extremely wide valuation spreads, and you had the the pop in value stocks. I mean, value spreads are there's lots of ways you can measure this, but if you just measure the deviation in value between the cheapest stocks in the universe and the most expensive stocks in the universe, the spreads are wide, and in fact they're wider than at almost any point in history, other than they were during the internet bubble. And if you measure it in other terms, these are all statistical measurements. So we tend to measure things in price to book terms, which is what you can see on the chart that you're looking at. When you look at it in price to earnings terms, it actually looks like this. The spreads today are nearly what they were during the internet bubble. So you had this nice, if you want to call it that, combination of stocks that were out of favor were very cheap, stocks that were in favor were very pricey, and cheap stocks tended to be cyclicals. The expensive stocks tended to be either the highly growing companies that responded to low interest rates, and that's arithmetic. I mean, I think you all know that if you're discounting a cash flow stream that's growing, that as the interest rates go down, you're going to have a much, much bigger impact on the present value than you would do for something that was stable. But what's interesting is stable stocks also were the beneficiaries of falling interest rates. And so the consumer staples, the utilities, the real estate investment trusts that were sort of the dominant players in the value indices during the kind of anti-value period of the last year, all did well because the investment community saw lower interest rates and bond yields are so low. So we used these stocks as bond substitutes and raised their valuation. The interesting thing is because there was so much uncertainty surrounding cyclicals, those lower discount rates didn't get applied to cyclicals. It was kind of a unique situation where theoretically you should lower the discount rate for everything, but we lower them for growth stocks and we lower them for stable stocks, and we didn't lower it for cyclical stocks, leading to this wide valuation dispersion, which had a mini unwind in the fourth quarter.
Rich, do you think this rebound that we experienced in the fourth quarter will continue? And what is your outlook for 2020?
Well, as I said earlier, I think the idea that we're heading into a recession has faded. Again, I'm going to take out of the equation things like world health issues, because these can put short-term noise into any situation. But if you're talking about fundamental structural drivers of recession, that meaning excesses, I don't think we have that. Right? I think that if you look over the last 10 years, again, you would see the biggest factor in the economy, which is consumer spending, has been relatively modest growth for 10 years without anything excessive going on. There were no big excessive housing spikes or consumer borrowing spikes, and even autos, which got a little bit ahead of themselves, didn't get massively ahead of themselves. So there's really nothing to recess from, and there doesn't appear to be anything to recess from going forward. On the industrial side, we already had this correction. So now most of the underlying economic data has looked good. And obviously the last few days has thrown a wrench into that. But I think that will be a temporary wrench.
So, Rich, do you continue to believe 2020 will be a good environment for value investing?
I don't know. I mean, I actually never know how to answer that question. I hope. I think, again, let me put another longer term perspective on this, because what I really think people call as this terrible period for value investing wasn't really all that terrible. I mean, if you look at our US large cap value performance over the last decade or so, if I was sitting here 10 years ago and I said to you, oh, I think we could earn 12% a year compound returns over the next 10 years, you probably wouldn't have believed it. And then when we actually produced those returns, the odds that you would have been annoyed with us for those returns you would think would be ridiculous. But here we are underperforming the S&P 500 after making 12% a year for 10 years, because the S&P was up 13 or 14 or whatever the number was. And so I don't think you could describe this as an anti-value environment. Actually, if we can make 12% a year for the next 10 years, I would be thrilled. And by the way, I think we can. Here's a chart that's up on the screen that compares the PE ratios over the last 70 years for the cheapest stocks and the most expensive stocks on the basis of PE. Very simple curve. So what you can see is cheap stocks are always available for 10 times earnings. That's the conclusion that you reach. Today is no different. So we're buying companies for the same valuations that we bought 10 years ago. And really, since we've been in business, and since as far back as you could find, there's always a group of companies that people don't want that sell for low valuations. They're different companies all the time. You have to rotate in and out of the ones that are cheap. So I would expect, if somebody asked me, and this is not quite answering your question, what do I think is going to happen in 2020? Because the reality is I have no idea. But if you want to ask me what I think is going to happen over the next 10 years, I think we have the opportunity to make those kinds of double-digit returns today. The cheap stocks are discounting future cash flow streams, reasonable, not aggressive views of the future that would make you think you can earn a double-digit return buying at today's valuations. And just collecting the cash flow streams has nothing to do with hoping for revaluations upward. As you can see, the cheap stocks never get revalued. Hopefully the ones that were cheap are no longer cheap, so some of them might get revalued and get replaced by other ones. But mostly, if you look at the cash flow streams that these companies have to offer, there's double-digit return potential. Compare that to the most expensive stocks. Well, this is where things have gone more crazy. I mean, for the last literally, obviously, the most expensive stocks are always more expensive than cheapest stocks by definition. The question is, what's the magnitude of that difference? And you can trace back really to the peak in interest rates in 1980, 40 years of valuation expansion for the expensive stocks and no valuation expansion for the cheap stocks for the most part. So I think, and I don't know what to forecast, but I think the last 10 years for the expensive stocks, that's the thing that you can't believe could be repeated. And really there's a couple of reasons for that. Because if you actually think about the world phenomenon and factors that influenced stock market valuations in the last 10 years, there were two very important criteria. One, capital was available for almost anything that you would want to invest in, particularly anything that had the prospect of disrupting a business that had a very, very large market. So the capital flowed without a clear understanding of how these businesses would eventually make money, just that someday they will make money. And you want to do everything in your power to grow these things as fast as you can so that you become the dominant player. The venture world and the private equity world bought into all of this. And so we've been able to build very, very large businesses that now competed and to some extent disrupted the existing businesses. Turning those into companies that have actual profit models is another thing. I mean, I know we look at Amazon and we say Amazon built this amazing business, spent a lot of its profits reinvesting in that business to keep it growing. But the reality is it was 7 or 8 years of needing outside capital from inception, not going on and on and on and on. And you get these things like a WeWork where we had I think what will become a significant milestone looking back in history, that all of a sudden there's some questioning about, is this really worth the prices that we've been paying for it? Because the remarkable thing about WeWork is it took something like 4 weeks for the company to be almost bankrupt post its failed IPO, meaning that the management team was so confident in its ability to raise capital that it didn't worry about pushing it to the last second. And all of a sudden the market says, no. We've seen some of those issues in Uber and Lyft, and where they've already grown to dominant scale and still don't make money. And some argue they make money in their core business, but they invest in another business. But a lot of what's going on is trying to provide justification for why the valuation should be so high. We don't have to even get into a debate about whether these are good business models or not, but it's not that hard to debate that the valuations are betting that they're going to perpetually be able to come up with things that drive growth rates to astronomical levels. And maybe for sure, that impacted markets in the last 10 years. And you add to that the interest rate decline that I discussed earlier, and those two things characterized massive growth in the S&P 500, which was dominated by these big new emerging franchises that had valuation expansion. So I think when we sit here 10 years from now, looking back, I would be shocked if the S&P 500 matched the 14% growth rate of the last 10 years. I would be less shocked if the value investors matched the 12% of their last 12 to 10 years.
Thank you, Rich. Changing gears a bit, we often get asked by our consultants and prospects whether value investing is dead. And also, isn't value just a factor? What are your thoughts on that?
Well, value is a philosophy. It's really not a factor. Value, I mean, when you sit there and you say, "How is value investing dead?" It's almost a crazy concept. That's like saying buying things cheap is a bad idea. I mean, how is that even remotely possible? Now low price to book investing might be dead. Low PE investing might be dead. That's not value. That's just a factor investing. There's no thought process that goes into doing that. And we all know, we've always known, that book value is a flawed measure of what the underlying worth of assets are on a balance sheet. We've all known that earnings can be manipulated and are cyclical. So the idea that suddenly we're concluding that these things are flawed and they don't work anymore is I don't know. It's a possibility, but that has nothing to do with value. That has to do with factors, and so there are plenty of times when value is high price to book. There's plenty of times when value is high price to earnings, because book value doesn't determine the underlying worth of every business. And earnings don't determine the underlying worth of every business, particularly if the earnings are cyclical. We always knew that as a value investor, you always know that a cyclical business, when the PE is low, it usually means the cycle's about to end and the earnings are going to collapse. And when the PE is very high, it's the time that you want to invest. So I think there's always been flaws. I think we've had an obvious period in the last 10 years where those factors haven't worked. But value, if you actually said, and you do what we did, you could have had pretty reasonable returns that would have been competitive with the kind of returns that you have earned in value over the last 50 years.
Just for the benefit of our audience, can you just describe a little further about our approach to value?
Sure. For us, value is based on what the normal earnings of a company is. So I know the concept is not an accounting concept, but it's not a very difficult concept. It's a concept of what should the business earn over a full economic cycle, given the industry it competes in, its competitive strengths and weaknesses, and given the management and their business plan, what's it rational for this company to be able to earn? And you can estimate normal by looking at a long history, but the reality is it's common sense. So let me give you an example of where low price to book investing deviated from value investing. Remember that when I was talking earlier about the post-China boom meltdown in commodity businesses and basic material companies. I'm going to use iron ore as the example because for 100 years, the price of iron in in constant dollars was around $50 a ton, and it cost about $40 a ton to extract that iron, and so you made $10 a ton profit. By the early part of the previous decade, the price of iron ore had gone to $180 a ton, and the profit was 140, 14 times quote unquote normal. So if you're an iron ore miner and producer, what are your business plans? I mean, because they all had the same business plan, which is expand capacity as quickly as we can so we could take advantage of the $140 before it's gone. And who cares what happens after that, as long as we get all of our money out before the party is over. So now you're the manager in charge of making that happen. And you call up your local engineering company and say, I want to expand capacity. And they say, sorry, our crews are all booked for the next 4 years. And you say, well, you got to be able to do something to help me. What if I paid you 3 times your normal price for your work? We could squeeze you in. And you hire overtime labor, which you paid overtime to in the construction process, and you expedited the steel shipments to build the facility. By the time you were done, you capitalized costs way in excess of true replacement cost. So that when things turned negative and the stock prices collapsed, these dropped below book value very quickly, even though it was pretty clear from, I would say, non-brilliant research to spend an hour and say, something's wrong here. I don't think the book values fairly reflect the true underlying value of these businesses. Let's not use book value. And, I could take the opposite side of it, like Microsoft or Google. The Microsoft stock, while it's a high flyer today, stock was $20 a share 5 or 6 years ago. And it wouldn't have screened up on a price to book basis. But if you looked at the underlying earnings power of this business and understood how powerful the franchise was, you would say, this is maybe interesting on price to normal, whatever you want to call it, earnings. And so to me, a value investor has a scale, a quantitative scale on which they judge cheap or expensive. A factor is a computer with no judgment and just buys low P and low price to book, or whatever the formula is that some sophisticated quant comes up with. And there's a correlation because obviously value is low price to something. It's just that something should be commonsensible and not flawed factors.
Rich, changing directions again. I know we are not macro investors, and we are certainly focused on company level fundamental research. But many, I know in our audience, will ask, what will the US election mean for equities and specifically for value equities?
Well, you'll have to forgive me for not answering this question. And I got asked this question on a panel in the last election cycle, and I never got invited back with my answer. So maybe I won't get invited back into this panel again, to this discussion again. But, I was in a group of professional strategists who all have to answer this question and spend their life answering this question. And everybody had this very interesting answer. And then it came to me, and my answer was, if you're worried about the impact of the election on the stock market, you probably shouldn't be invested in the stock market. The stock market is a long-term game. And the reality is you're investing in a company and getting a stream of cash flows. Predicting where that stream of cash flows goes in the long term is very hard. In the short term is very hard. In the long term, you have lots and lots of evidence that companies are run by people that have a lot of ingenuity, and they react to adversity. I mean, look what they did in reacting to trying to trade tariffs. I remember when the tariffs were first announced, reading all these research reports from Wall Street that said, look at the impact on company A, company B, company C, and company D. And the way they did that was they took the amount of stuff they imported and put the tariff on it and charged it against their income statement. And that, I mean, it's crazy to believe that that's how a company would behave. I mean, if there's anything that was amazing, it was how fast people were able to source from a different location than from China and preserve their franchises because it's people. And so I think if we get a different election outcome and there are different issues, let's say we get higher taxes or more regulatory burdens or something that will spook Wall Street, I promise you, the companies that run the management teams that run these companies will figure out how to behave like they've done for the last, as far back as you can find data on corporate profitability. You can see that corporate profitability is in the long term unimpacted by interest rates, tax rates, inflation, unemployment, all the things that what we spend our whole life worrying about. In the short run, they do. So as an investor, you have a choice, trying to guess what the short run is going to be and position your portfolio accordingly, or try and buy good franchises where you think the management will be able to navigate whatever gets thrown at them. And I think the latter is a much smarter way of investing.
Rich, why are you overweight financials in most portfolios, particularly in the developed markets? And what do you expect from them in 2020?
We're overweight financials. Let's start with banks because it's probably the biggest position. But I'm going to use US banks as an example. US banks are the envy of the world. I mean, JP Morgan's probably the best bank in the world. But certainly all of the big American banks, they have a couple of very interesting advantages in global finance. Mostly, they happen to have a source of dollar-based deposits with which they can lend globally because the world borrows in dollars. And if you're a European bank and you want to play in the global scale, you don't have a funding source, so you have to come up with a wholesale funding source. That contributed massively during the financial crisis to the share loss in global finance of many of the European banks. The American banks are earning the best returns of their history, with the exception of the crazy period before the meltdown before the global financial crisis. And that's when they overdid it with the leverage. Today, they're exploiting their strong deposit franchises to earn relatively interesting returns on equity. So the big banks are earning, mid to high teen return on equity and selling for somewhere between book value and 1.5 times book value, depending on the bank. And you take other companies that have ROE based results, like electric utilities, which we view as kind of stable. Electric utilities earn 10% return on equity and sell for 2 times book, and banks earn 18% return on equity and sell for 1.2 times book. And so the valuations never reached fair. And yet the quality of the franchises has only improved. The technological capabilities of these banks have only improved as they've embraced a lot of the innovation of fintech operators by buying them because they have big pocketbooks and incorporating their technology into an offering that has a customer base that's incredibly sticky. And that's led to margins which are not appreciated by the stock market. And so even if nothing happened in valuation, I could buy a bank today and basically get something like a 10% free cash flow yield, if you can accept that concept in a bank, that grows in line with nominal global GDP. There's no growth story, but the total returns are double digit. You're hard pressed to find something like that with as great of a franchise as you can find in financial services.
Thank you, Rich. Rich, also, can you tell us where else you're finding value across the U.S. portfolios at this point?
Well, I think there's value in energy. There's value in autos. There's value in industrial cyclicals. There's value in financials. It's hard to find value in staples. It's hard to find value in real estate or in utilities. And there's selective value in technology, but the stuff that everybody likes is not the value. It's the stuff that people are concerned about. But energy is an interesting controversial area because you can see on the chart here, and what this chart does is it takes a long history of capital spending. That's the blue bars. That's a history of total amount of money spent on exploration and development of oil and gas property reserves. And then the line is the reserve replacement rate. And you see that we've particularly in the last 10 years, almost no matter how much money we've spent, we haven't been able to replace reserves. And you can argue, well, maybe that's okay because nobody's going to need oil in the future, so why bother replacing the reserves? But when you start looking at how long we're going to need to produce oil to meet the demands of the existing car fleet, if you accept that demand is primarily a transportation fuel for oil, and then gas is going to have an offset because it's going to be used in electricity generation. But sticking with oil, the growth in installed fleet of cars around the world, mostly coming from the developing markets, plus the growth rate in the number of miles that we drive every year, has driven this steady growth in oil demand forever. And to transition to electric vehicles, which is happening, no doubt about it, most of the forecasters that forecast oil demand don't see oil demand peaking for 10 to 15 years. And reserve lives are now starting to drop below that. So, and we've pumped all of this capital spending into fracking, oil shale in the United States. I would call oil shale the kind of revolution that's like the other disruptive technologies. Sounded great because we have, quote unquote, a new technology that has a massive market, that can do things better, and can create energy independence for America, and money poured into it. And there's enough evidence now that a lot of that money isn't going to earn the returns that were promised. And that capital spending puts the world more on a treadmill, because those reserves, those are short reserves. You produce most of the oil the first year in a fracking well, and then production declines very rapidly. So you have to spend money to keep that treadmill going. And yet oilfield services stocks have collapsed. They've collapsed way more than oil prices have, because there's some sign of weakness, particularly in US fracking. But I think that this is an opportunity here. Valuations are very, very cheap, and it could be another super cycle here in drilling and spending, because we're not going to stop using oil for a long, 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 long time.
Rich, are there any additional sectors that you want to highlight?
I'll highlight one more: autos, and autos are obviously cyclical stocks, but they also are facing a huge amount of uncertainty because of this transition to electric vehicles, and people don't want to invest because they don't know how to handicap who's going to win and who's going to lose, and they know there's a lot of money being invested. But there are plenty of auto-related companies that you could buy in the market that are suppliers to the auto industry that would also be suppliers whether the cars were electric or gas. I mean, you could think of things like tires and interiors, and there are plenty of components in vehicles that where you don't have to take that bet, and the valuations are still fairly compelling and sort of 10+% expected returns.
So here's my last question. What keeps you up at night? What is your biggest worry at this point?
Look, the worry from a I'm going to answer the question from a business perspective more so than from a market perspective, because in the end, markets have a way of allocating returns in a proper way. So the difficult part from a business perspective for us is there can be extended periods of time when what you do is not in favor, or at least people are worried about it. Or my biggest concern is that our investors don't have a long enough time horizon to see this through. And while that hasn't been the case, I mean, it's been the opposite for us. It's probably my biggest concern.
Okay. Thank you, Rich. And lastly, we put together a podcast on GE, on General Electric, where we did a deep dive into the work that we did there, and it includes a discussion between our co-CIO, John Getz, and one of our research analysts, Dan Backus. So that, I believe, just went up on the Apple Store and Spotify and all that, so you can take a listen to that as well. Let us know if you have any feedback. And since we have no further questions at this point, I just want to thank everyone for joining us today. Rich and I greatly appreciate your interest in our firm. And lastly, please see our contact information on the screen. For further information, you can find us at www.pzena.com.